Hi, everybody. Pleasure to be here. The first thing I want to tell everybody here is two things. One, the good fortune that David made reference to. But two, the real reason that people ask me to speak at any kind of event is really to prove that, anybody, even people of average intellect, can be successful value investors. So I'm not the smartest person. I'm not the hardest working person. I was definitely not the best student. And in spite of those things, I was successful. And the reason it was because of good fortune. And the good fortune was I just happened to be in accounting, and I happened to not be able to be smart enough and get good enough grades to work for a big 8, now big 4 accounting firm. So instead of going down a track of what would have happened had I done that, I ended up in a different place, and I had the great fortune of auditing Tweedy Brown. So as David also points out, value investing or small cap investing, all of those things I never really understood the nomenclature of because I just was stuck in an environment where I sat in Tweedy's office for 4 years and talked to people who invested and learned what investing was, which is not, of course, what the world generally kind of thinks about it and what you normally go to school. You have the great advantage of being even better than me because it isn't by random luck that you happen to work for a firm that did value investing. You selected a course to therefore drink the Kool-Aid and early on get the secret to what investing is all about. So you're ahead of everybody else because you're in the right place, fishing in the right pond, thinking the right way, and that's a huge thing. So as David said, it was about 30 years ago in 1983 that I started Robotti and Company. The niche of the firm has always been small to mid-capitalization companies that we think are misunderstood, neglected, out of favor, obviously leading to the capability for them to be mispriced. In 2004, up to 2004, the primary focus was North America, originally the United States, but then many years ago I came to Canada because I've had an interest in energy investing for many years, and 12, 13, 14 years ago realized that since I only know one language, English, and I'm not so good at it, in Canada, at least in the western part of the country, they speak the same language, and the oil and gas companies are pretty much the same without regard to that border. And so therefore it was a pretty easy export for me. Then in 2005, Isaac Schwartz, who's been with us 10 years now, convinced me to look overseas. And in spite of all the trepidation I had originally about investing overseas, because as I say, I'm even limited in my capabilities of my first language, English. I'm definitely not going to know any other language. But I figured what the heck, he's a smart young guy, he knows a lot of things, let me try it. And it was a great opportunity because there really is a great, significant investment opportunity overseas. We were fortunate that Isaac took me to Thailand. Pretty much all the management speak English, so therefore made at least conversation easy. The financial statements are all reported quarterly in their SEC, all translated into English. The securities themselves, there were a vast number of companies that traded extremely modest earnings multiples with good balance sheets, having been 7, 8 years of repair post originally the Asia crisis that was led by the devaluation of the Thai baht. So therefore we've been investing overseas. Isaac himself actually moved to Singapore in 2007 and for a number of years has lived in Hong Kong. The firm's philosophy is that value is the foundation of the investment process. As I say, that's all I know is value investing. We believe that the market prices for securities frequently do not reflect the intrinsic value of the businesses, and we are guided by the philosophy in selecting companies we think are trading at significant discounts to intrinsic value. I've kind of touched on this background, how I got into the business, seeking out great mentors, and that's what it was. Is the accounting firm that I was with was a 25-person firm, but we audited Tweedy Brown. So for 4 years' time, I had the ability, when Tweedy was a much more modest firm than what it is today, managing many fewer assets, but also having people like Howard Brown and Ed Anderson and Will Brown and Chris Brown at early ages. John Spears, who's a 35-year experienced person today, young and helpful. Walter Schloss, Eddie, and his son Eddie Schloss was a good friend. So that was my view on investing, and what it was talking to these people on a regular basis, and most importantly, It was originally Tweedy, Brown, and Riley, and Joe Riley had retired, but came in pretty much every day at around noon, 1 o'clock, and then the auditors sat in the same little room, and so at 6:30 I could talk with Joe about investing as opposed to doing some ticking and footing in my accounting work. So it was a great introduction for me. Then, further good fortune, right? The accounting firm also audited Mario Cabelli. So in 1980, I went to work for Mario as his chief financial officer, probably an overinflated title since it was a 12-person firm at the time. But I handled all the accounting, finance, a number of other things, administrative for the firm. And most importantly, it really was an on-the-ground MBA program. So for 3 years, I worked with Mario every day. And that included sitting in on all the morning meetings and what they were looking at and why Mario liked an idea. So every day I had a class in how to pick a stock by Mario Cabelli. And he paid me as opposed to I didn't have to pay him for the program either. So another great fortune and opportunity that I was given. The business itself, what attributes, what experiences have been important, I really do think that accounting has been an extremely important advantage that I've had because accounting is the language of business, and also working on how to prepare financial statements, how to create financial statements, how to audit financial statements, and therefore all of the capability of when we look at financials, what went into that process, and all of the sausage making that went through that, and therefore all of the things that it tells you, it may tell you, it might not tell you, it may mislead you, all of that. So, I have an appreciation for the creation of those numbers, and those numbers do tell a lot about the history of a business, and the history of a business gives you some capability to have some projection as what the future might look like too. What is value investing? We believe that there's a disparity frequently between the price of a security and the value of a security, and we're also looking, when we do invest, for a margin of safety, for reasons I'll touch on later on. One of the things at this point I want to talk about is margin of safety, and obviously Danny DeVito there talked about margin of safety. And what I want to stress to you is that margin of safety is really important. Obviously we don't look at companies that have small changes in assumptions have a significant impact on valuations. But the thing about margin of safety is it really protects against the fact that I make a lot of mistakes. And when I do make those mistakes, it really moderates what impact that has on the aggregate portfolios that I'm managing. So margin of safety is obviously an extremely important part of value investing. Idea generation, what's the secret? We don't think there's much secret here. We think that we look at securities like most people do, and we screen, we look at special situations, we look for screens based on criteria. We look for asset plays, out of favor stocks. So we're looking kind of the same place everybody is. And I imagine, that's not, we think, a key to the ability to be a good value investor. And then, there are issues in terms of how do you think about value and where are you in the spectrum. And I guess the classic people think about, of course, is Graham, much more analytical balance sheet approach, and of course Buffett being much more oriented toward business valuations, which obviously are kind of more complicated and more difficult and not as obvious as a calculation on what net working capital is per share. Of course, ideally, we think that what you really look for is, of course, a company that on valuation is cheap, and in terms of the quality of the business, in spite of various factors, it's really much higher than people perceive it to be. Small, obscure, ugly, why do we focus on that? One of the important things we talked about was, that David said earlier, was this idea that the perspective I've had about investing is small cap value is kind of where I've always, that was what Tweedy did when I was auditing them, that's what Cabelli did when I worked for him, that's what our firm did when we started, and it was always immersed really only in that subsegment. And I never really fully realized that until 2005, 2006. The SEC formed an advisory committee for small public companies. There were 26 members of the committee. I was one of the members. I was the only member of the committee who was an investor. There was also Kurt Schott, who was the head of the CFA Institute. so therefore users of financial statements and analysts, but everybody else was either company people, auditors, people part of the process. So I thought that was kind of interesting in hindsight. Of course, who the SEC picked to review its rules for small companies wasn't any of the people who were the intended users of those financial statements. But it really highlighted to me how differently most people in the investment world think about investing and what the process is all about, and how when they look at companies, their appreciation, obviously it was easy enough for the person who was an ex-senior SEC person who was then head of Maverick to say there should be the same standards, the same rules for all companies. The cost-benefit analysis is an irrelevant consideration. Of course, when she was asked, did Maverick invest in small-cap companies? No, they did not, because they didn't think the financial statements were such that they could rely and depend on them. At the same time, then she was asked, do you invest overseas? She says, oh yes, we invest a lot of capital overseas. I said, well, your reliance on financial statements prepared overseas is much better than U.S. small-cap companies. So I think, what it really was is that isn't an area she was interested in investing in. She came from an environment that talked about, one size fits all, and therefore to have a different perspective, because there should be a cost-benefit evaluation, was not something that entered into her perspective. Knowing where to fish, we think, is really important, because what we are looking for is asymmetrical opportunities. Companies, of course, that provide us extremely high returns over time and minimal risk, although not minimal risk, because I definitely will invest in companies where I do think I have downside risk, but given the upside and downside potential, we think that makes sense. A lot of what we do also is, illiquid, international, cyclical. All these things are important in terms of where people don't look. We find in the U.S., because we also do have a broker-dealer and therefore talk to small-cap value managers, and frequently in conversations, we'll talk about, oh, gee, we think a really interesting company today is StoltNielsen. And they'll say, so where does it trade, New York or NASDAQ? I say, no, it trades in the Oslo. Well, we don't invest in overseas companies. Or Calfrac, you should look at Calfrac. Well, that's a Canadian company. I don't invest in Canadian companies. So even large U.S. managers have certain mandates that really close them off to what's the best investment to make, as opposed to this is the little box that I've defined as an opportunity, and that gives opportunities to others. A lot of what we do invest in is we would think invest in companies we think are really ugly ducklings. And many value investors say that they look for companies that are beaten up, out of favor, all those things. However, we find that common to most investors is they avoid uncertainty at all costs. The idea of losing money in an investment, even on a market-to-market basis, is unacceptable to most managers. And therefore, even though they espouse the concept of, yes, we'll invest in companies that are out of favor and in difficult situations, the reality of it is that's very hard for any professional manager to overcome. And what we also think is part of our key to success over time is the ability to lose money on a mark-to-market basis. Frequently, when I buy a security, I've actually, having done it for as long as I have, I come to assume that my first purchase will be one of my more expensive purchases. And unfortunately, my record has proven that to be the case. And of course, over time, the companies that we've invested in that we've made the most money and have been the most successful in are the companies that, our initial purchases were definitely at higher prices and it traded down after that. We don't tend to sell companies when we're wrong. And yes, events unfold, values become more determinable, there's some impairment, but frequently we find that the market overstates that decline and therefore already adjusts itself. And given where we are at the time, consider that the price to value equation still makes sense to either own the stock or buy more of the stock. How did this mentality of holding on to things and continuing to invest, even losing money? The very first investment I ever made was in New York City Housing Authority bonds. So in 1975, I graduated college, and New York City was going to go bankrupt. And so New York City housing bonds traded at 33 cents on a dollar. So within a couple of years, they were trading back at par. So it was an investment that worked out extremely well for me, and somehow embedded in my mind this idea that frequently things could be wrong, and there are opportunities when people think that the downside is extremely bleak. And then that emphasizes the idea that if you want your performance to be different than the market, you obviously have to do something different than the market. So much of professional management today, active management, probably does mirror the indices, and therefore they're not doing something different than the market. Our job as contrarians, of course, many people will say, you have to watch out, you can't catch a falling knife, it's too dangerous, wait until the dust settles and the uncertainty is resolved. Here's a quote by Howard Marks pointing out that frequently when the dust is settled and the uncertainty has gone away, the opportunity, the great bargain, has also gone away with it. And so therefore, the combination of the ability to continue to look and to take the risk that it is a falling knife and losing money on a mark-to-market basis, but continuing to stay with that investment is what we think has generated our returns over time. And having made those mistakes and having made those investments, that's what we really look for today, is we look for companies that we really think have a very long runway of opportunity. So we're not talking about companies we think can double, but more triple, quintuple, or even have higher returns over time and have a very long runway of opportunity. And we find that frequently happens with companies either by themselves with their dynamics or in industries that are going through extremely difficult times. The process itself also we think is beneficial. The difficult times, of course, causes management to look at the situation, look at their opportunities, potentially get out of businesses they shouldn't be in, cut back, scale back costs, competitors go out of business. So there's a cathartic process, of course, in going through difficult times that winnows down the competitive landscape and potentially sets up a great opportunity for improvement over time. So those dynamics, where they're in place, lead to a very long runway of multi-year opportunities. And a key part to being able to do this, we do think, is a behavioral edge, and that is the patience and discipline. Since catalysts aren't necessarily identifiable, frequently value investors will say, well, but I only want it with an identifiable catalyst in place. If there's a catalyst in place, you're not the only person to probably recognize that catalyst, and therefore that's probably priced into the equation in some security. Is it not fully reflected or not? That's possible, but there's, we think, more risk from a timing point of view. Instead, we're looking for businesses that we don't necessarily know when the timing is, but we have a high conviction level. There really is a reversion to the mean in that business, and that reversion to the mean is significantly different from the current situation of the company. We think there are three kinds of edges, right? There's an analytical edge, there's a behavioral edge, and an informational edge. We think potentially one of the things about the behavioral edge, and that is to have that long view and have the temperament and capability to sustain mark-to-market losses in the interim while we've invested in a company, leads to a different kind of analytical edge or informational edge. Because I'm not actually smart enough to have an analytical edge, and I'm not well connected enough to have an informational edge. And so fundamentally, I don't have those. However, given the long-term perspective I have, I do think we have an analytical and informational edge because we're looking at the right information and we're doing the right kinds of analysis. And that is, what does it, in 3 to 5 years, what do we think the opportunity is with this business? What does that imply for its value? And that's the focus that we want to have, as opposed to what does the next 6 months look like, which we'll never be able to figure that out, and we definitely won't have an informational advantage. So the approach we have and the focus we have, we think, enables our behavioral edge to give us those two edges, the analytical and informational also. Here's pretty much a restatement of how we think the behavioral edge gives us an advantage and enables us to have that analytical and informational edge. Okay, undoubtedly I probably bored you a little bit by going on a diatribe about all these things. So we have three fundamental questions here. So this is give and take. So why does anyone buy a stock? Nobody knows an answer. Why does anyone buy a stock? Why would anyone buy a stock? Yell out answers. Don't raise your hand. I can't call people. To make money? That's it. They think it will appreciate in value. They buy a stock because they think it's going to go up. Right. What makes stocks go up? Demand. Sorry? Demand. Yeah. Anything else that makes stocks go up? Expectations. About performance of the business and where they're headed. changing expectations, events unfolding different than what the market perception is at the time, right? And what's so important about cash flow? Right, and the answer to that is when we're looking at trying to figure out the intrinsic value of a business, right, the intrinsic value of a business is predicated on the assets, the businesses that company owns, and that's going to be predicated on the future cash flows of that business. And that's what we're looking at, is trying to figure out what the future cash flows of the business using the information we have, the current existing data, and of course the historical data on a business. So what are the implications for investing? For value investing to work, the first thing is you got to be able to have a reasonable estimate of what its intrinsic value is. Secondly, you got to find the security that the market has a different view and therefore is fundamentally mispriced and significantly mispriced the security that gives you that opportunity, and also significantly because we want a margin of safety, because things will happen, we'll learn things, we'll make mistakes, all of those things to protect us for events that unfold and mistakes we'll make. And the market eventually, of course, has to realize that differential and reprice the security. To translate the theory into practice, there's a number of different things, right? One is you could have a low price to book. And why is that? Obviously, the assets that are part of the business are producing no or insufficient cash flows, at least at the current time, to enable someone to envision a valuation significantly different than the market. And then, of course, there are also companies that have low price to earnings, and those businesses are ones in which the market is concerned that those are not sustainable earnings and there will be declining earnings. And frequently, in one of my companies in particular, that's the case. The market doesn't believe the historic numbers and has a very low valuation on the business because it doesn't appreciate the cash generative ability of the business, and therefore doesn't think it's sustainable. And then, of course, that's what we're looking for, is the purchase of assets where either there's developments that will occur or that are occurring that have either been unnoticed by Wall Street or are noticed by Wall Street but believed to be too far into the future to be investable today. Value investing itself is, of course, many different things. It's knowing where to fish, we think. It's the ability to estimate intrinsic value. Invest only when there's a significant margin of safety, so the significant difference between that intrinsic value and the market price. There's a variant view that you have potentially on the future cash flows of the business, and the market isn't properly capitalizing that. A behavioral edge, and that's the ability to maintain the proper temperament, and that means having that longer view. To be a contrarian and to invest in other in companies that potentially make others cringe, and the patience to wait for the time that Mr. Market can come to realize the same thing you have. And then the next part here, we're going to try to go from theory into practice. And then David, I think appropriately, loves this quote here. And it's, in theory, there's no difference between theory and practice. In practice, there is. The first company I want to talk about is Builders Firstsource. It may be in there. I think it's one of the ones. It's the back of the first page. Builders Firstsource is a leading supplier and manufacturer of components to home builders in America. Company operates in 9 different states, 53 different distribution centers, and 44 manufacturing facilities. The current price is approximately a little less than $6 a share. There's about 100 million shares outstanding, so it's close to a $600 million market cap. There's $300 million of debt, a little less than $100 million in cash, so a little less than $800 million market cap. Here's a graph of the stock and what it's done over time. As you can see, it starts in 2005. So 2005, 2006, home building in America was at significantly different levels than where it is today. And then, of course, you see what happens when you go from 1.4 million homes in America to 450,000 homes in America. Significant decline in this business. So in 2009, we visited the company and began to invest in the company under the belief and under the premise that the building of the homes in America is 450 is not a sustainable number, and instead, a number somewhere I guess like Danny DeVito likes nice round numbers, and nice round numbers, 1 million homes, is probably a reasonable estimate of what the sustainable minimum new home construction is required in America. In visiting with the company, we also talked about what they've done in the past, what margins they've made in the business. It is a distribution business. It's therefore not fixed asset intensive. It's working capital intensive. That helped them in the process when the business did decline. There was significant cash that was generated from liquidating the inventory and decline in receivables, so that did moderate the company's difficulties in difficult time. But when we're looking at it, we're saying, gee, if this business does 1 million homes in America, we think that they'll do, on average, about 2,000 per home. In the past, they've done at least that. We think the revenue-generating ability of this business is $2 billion. In discussions with the CFO, they had mentioned how they've done a number of different things about cost cutting, and they thought an 8 to 10% EBITDA margin was achievable in this business. So here we thought it was a company that could generate $2 a share in EBITDA. As I said, it's a distribution business, not capital intensive, and so therefore we think a distribution business like that is worth a higher multiple. So therefore a 7 times multiple is a reasonable multiple for that business. So we think we have an equity that was worth potentially significantly more. The problem, it's not that simple, of course, right? Because when home building was still declining, the trend was negative. When was it going to turn? The timing, of course, is greatly uncertain. It also was complicated by the fact that the balance sheet of the company was not debt-free, and so therefore through this difficult time, had a number of different issues and continues to lose money even today with the beginning of a rebound in the business. So then when we had to look at it was, gee, an important thing is, okay, we're investing in a business in an industry that's clearly significantly depressed, that we think has a much higher earnings capacity of the business. The next question is, okay, if we buy the common stock of the company, are we going to be the owner of this business when that recovery comes? And so that was the biggest risk that you kind of had here, is not only the timing was less relevant given it was probably a $3.60 stock and $2 EBITDA number and a 7 times number, gives you, if it takes 5 years, obviously a great annualized rate of return. What you do have here also is there are 2 shareholders, it says in there, JLL and Warburg, each owning 25% of the company. So this was originally private equity. They had taken it public, but there's still 2 significant financial players who were backers of this business, and we thought that was a key component to this company coming out the other end. What we also realized, though, is there's definitely a risk that they'd need to raise more capital, so there's a dilution risk. So the denominator, that is the number of shares, potentially could change over time. So those were some of the risks that we considered in our investing. In February 2011, when David went to that other school that's faintly affiliated with Ben Graham too, he started the Graham and Doddsville newsletter, and because of that, and for no other reason, they then wanted to interview me because he pulled rank. So we did an interview, and I talked to them, about Builders Firstsource, and at the time, it was a $2 stock, and then again was interviewed in the Value Investor Insight. It's okay, we don't have to flip back to it. Okay. And it was around the same level. It closed 2011 at $1.07. So in 2011, nobody believed that housing would recover any time in the foreseeable future. What's happened more recently, of course, is that while the housing market certainly is not out of the woods, the headlines and the rhetoric have significantly changed tone. We could argue that the dust is just beginning to settle, and here this does reflect a difficulty in waiting for the dust to settle. The security is appreciated dramatically, so as I said, it ended the year, I think, at $1.70 in 2011. It ended past year at over $5 a share. And the $5 number, as I said, on the valuation is not so discounted on a trailing 12-month basis. These are huge numbers. So there still are issues in terms of a value investor and a classic balance sheet approach or capitalizing earnings was going to have difficulty buying Builders Firstsource. But again, by having that longer view, we have a high conviction level. We've spent a lot of time in the last 2 years knowing more about the business. It has a competitor that was public, went through bankruptcy, came out of bankruptcy, and over the last 2-3 years, we've accumulated 20% of that private company. And as a result, back in May, I went on the board of that company. So I now sit on the board of a competitor to Builders Firstsource, and have visited 20 different locations, been to multiple trade shows, have visited with vendors and suppliers, and think I have a pretty reasonable understanding as to what the potential outcomes are for the home building business, and that give me high conviction level that Builders is extremely well positioned, including visiting the market manager in South Florida. And today that business is half remodel. It's a fraction of its revenues, maybe 40 million of revenues would be my guess. And he talked about two competitors in that marketplace that were private companies that went out of business in the last 4 years that each did over 100 million of revenues in 05, 06, 07. So two very substantial competitors gone. So I think the potential revenue increment to that business and earnings improvement in the South Florida business is clearly a multiple of its current activity. So therefore, my conviction level on $2 billion of revenues has grown higher over time. The industry has consolidated. All of this is kind of information that you would get from spending time talking to management, talking to competitors, visiting locations, thinking about the business, thinking about changes in how home building is being done. The home builders themselves are less involved with the construction process and looking to outsource that to someone who can do more and more of the work. The idea that you could have a one-step distributor with efficiencies, delivering product to all the home builders in an area, and taking more and more product and doing more and more component manufacturing makes all the sense in the world. So I think there are more services they'll provide, and they'll have deeper penetration in a number of the component manufacturing projects they do today. So all of those things give us high conviction that even at today's apparent lofty levels, this is an extremely attractive investment for the next number of years. Another company that we, in 2012, have followed for close to 10 years, have visited with, but established a position in it is Calfrac Well Services. Calfrac's $25, $26 a share, so it's a $1 billion, $1 billion, $2 billion market cap, enterprise value $1.5 billion. The business is almost all hydraulic fracking. I'm sure you probably heard the term. There are two technologies that have led to a renaissance of the energy business in North America, and that one is horizontal drilling, so the ability to drill a well down into a productive rock zone that contains oil and gas, and then transverse that for a mile, and then to fracture that well to increase the likelihood of natural gas or oil in that well flowing back to produce is what's led to clearly a significant amount of natural gas and oil being produced and the growing capability inventory of it here in North America. The company itself, about 30% of the stock is owned by insiders. Obviously something that we always look for because then this is a cyclical business that's capital intensive, so therefore the reinvestment of that capital is extremely important in the future outcome of the business. And to think that that's being controlled by people who own the stock, obviously have aligned interest, think about capital allocation to create value, not to create a larger company, not to create a higher pay for themselves on a short-term basis. So, creates all the right disciplines. So obviously, if you're a value investor, you'll spend plenty of time looking at the potential alignment of interests and the ownership structure that increases the likelihood of success in investing. The business today is in one of the downsizing difficult times because it is a cyclical business. The capacity in this business has been overbuilt. The weak natural gas prices for the last year and a half have a significant decline in gas drilling. Gas drilling tends to be more oriented toward larger fracs, therefore more demand in that business. So you have an oversupply that's weakening in prices. Calfrac itself we think is interesting because it's it and Trican are the two Canadian companies that have very good position and have close to 50% of the market here in Canada, and that gives them higher margins, a better protected business. The big three in the business, which are Halliburton, Baker Hughes, and Schlumberger, have much lower shares here. In addition, Canada also is different because the advent of horizontal drilling and hydraulic fracking for oil is a couple years behind one or two of the lead places, and the lead place being really the North Dakota Bakken. So therefore, we think that there's continuing application of that technology and therefore growing demand for oil well drilling horizontally and fracking here in Canada. Canada also has the advantage we find in oil and gas companies that they're much more international than the U.S., right? The Canadian market is 15, 20% of the size of the U.S., so U.S. companies, when they're in an area and they want to go to a new place, go to some other part of the U.S. Canadians tend to look at the opportunity set and said, yeah, we can go to the United States, but that's a very competitive market, so tend to go to Russia. They have operations for the last 10 years in Russia. They go to Mexico. They have operations for a number of years there. They're in Colombia. They're in Argentina. So, and even small Canadian oil and gas companies tend to be much more international and take their service providers with them. And obviously, hydraulic fracking and horizontal drilling is a technology that's going to work a lot of places in the world, not just in North America. So therefore, the growth opportunity we think is great. So we think this is a really growing business with a great opportunity that is cyclically oversupplied today. And instead, we're looking at it as a company that earned $4.20 in 2011, and today has 60% more capacity than it did when it earned $4 and change back then. Supply-demand comes back into balance. Therefore, we think the earnings are significantly higher than where they were, and yet the stock today trades at 25. They've also been, in 2012, they cut back on capital spending, realizing the market was oversupplied. In 2009, when the business also was cyclically depressed, they bought 2 companies in the United States, bought them for asset value. So therefore, we also think they're also keenly identifying options to expand the business now in the downturn, so that cyclicality in someone who's intelligent and understands that and allocates capital provides opportunities to make acquisitions at the depressed times in this business. In the meantime, I spoke about this, was this at the Value Investing Congress? Yeah, so, no, in October. Yeah, and when I recommended it in October, I fully thought, it was 23 and change. I'm like, well, by the end of the year, the stock should be below 20. So that was fully my expectation when we bought a 3% position in it during the year, was that over time it's going to get worse than I expect, because that's what normally happens to cyclical businesses. It gets worse than you expect, and the stock would probably come down more. But I bought it in spite of that fact, and figuring that that's what would happen, hoping that's what happened, because if it traded down to 18, that would give me the opportunity to make it a larger position. It hasn't happened, but I can't cry too much about making a little bit of money in the interim. In energy, we tend to focus, and energy is at least about a third, maybe even 40% of what we do, but there's a very heavy emphasis on the service providers in that business and not on the commodity owners. And the commodity price is extremely volatile, and having been involved with the business for over 30 years, I have high conviction level that I have no idea in the next 6 months to a year where the price of either commodity will be. And the only thing I know about the price of the commodity is if there's widespread acceptance of what it's going to do, then that's almost guaranteed to be wrong. So our focus on service companies is that we're not dependent on what that price is. Obviously, if natural gas price is 4 or 5, right, that dollar increment is extremely important, right, because that's all goes, 90% of it plus is going to go to the valuation of that company. So, a dollar change in price potentially makes a company worth 50% more than what it was before. So that volatility in price, and given that we don't have a high conviction level on our ability to determine that price, means owning a producer is just more problematic for us. In the meantime, for the next number of years, one could clearly envision a scenario where North American gas barely gets above $4.50. So therefore, owning someone who owns a lot of natural gas reserves is not necessarily a fantastic investment. But we do think that there's a significant level of activity in the service part of the business to drill wells and produce that gas. And so therefore, we have a higher conviction level of the activity that will be generated over the next decade, but we don't necessarily have much conviction on the price that the commodity will actually trade at. So therefore, our predisposition is to look at service companies. On that slide, it showed obviously Calfrac, but also another company, Enerflex, which again Enerflex itself is also an interesting energy service company, because what they do is they engineer, design, fabricate, and sell compressors, and then do parts and service in the aftermarket spaces. It's not a capital-intensive business. One of the negatives to oil service companies are they tend to be capital-intensive businesses. And so therefore, a significant, Calfrac is definitely a capital-intensive business. As they double the size of the business, they double the fleet, they put a lot of capital back into new equipment. Enerflex, that's not the case. We actually think we can envision a scenario over the next 5 years where revenues could double, and we think the reinvestment in capital, plant, and equipment would be de minimis. And so therefore, the earnings being generated and the cash flow are discretionary, available to shareholders for various things, including distributions. So, that is a difference that we think from a lot of other energy service companies. Here's some attributes of Calfrac itself. The bottom line, we say, given, we think, modest expectations in terms of what the earnings were historically, the higher fleet count, that the earnings could easily be $5 to $6 a share on a $25 stock. So we think that's a reasonable investment that even if it trades at just a modest multiple of earnings, given that it's such a cyclical business, if you put an 8 to 10 times multiple on that, you still have a stock that over the next 3 years, and we would think within 3 years' time, the activity levels probably improve again, and therefore you've got employment of the fleet, and therefore the capability to earn that, and so that's going to be a good annualized rate of return. StoltNielsen is another company that I've had the misfortune of investing in for 15 years, and the misfortune of I haven't made any money on this investment. So, and what they do is it's a logistics transportation business, and they transport, store, move chemicals. Today, stock's probably a little over 20. It's got a book value of 25, maybe a little bit more. The sum of the parts, we think the business is worth $50 a share. There's significant insider ownership. We think the $50 per share number and the sum of the parts, each of those businesses have good prospects over the next 3 to 5 years to grow significantly from that number. So, we think it's very cheap today and yet has great growth opportunities that clearly the market is not agreeing with us on. And we think it's actually one of those companies in that slide, if you think back to it, that had cheap to expensive, and if you had low quality to high quality, it's a business that's down in that box down there, that this is actually a higher quality business than most people will give it credit for. And that it has demonstrated in the record of one of those segments for a long period of time. But we don't think that in any way is indicative of what the future holds in that company, and yet the valuation on it is extremely modest. And whenever we talk to people about the company today, people start to roll their eyes, people I know, because they've said, didn't you tell me about this 5 years ago and 10 years ago? And I say, that's right, I did. Here's a little snapshot of the businesses. There are 3 main segments. One, there's tankers, which is the original core of the business. 50 years ago, Jakob Stolt-Nielsen invented the parcel tanker, and so therefore the pioneer in the business. For moving chemicals, they've also gotten into 2 businesses they've been in for well over a decade. One of them is they own terminals. Terminals are, unlike the tanker business, volatile and have periods of time where no returns on invested capital or very low returns. The terminal business is one in which good returns, good predictability, and they've had a really good growth record here. And the next number of years, that growth continues because there's a number of projects underway where they've built out capacity. So the terminal businesses, and also one in which we think the valuation on it is easily 10 times EBITDA. Recently, in December, there was a transaction. Private equity firm in New York invested in its competitor terminal business for 49% interest and paid 10 times EBITDA for that business. So there's verification, on an outside transaction. The container business is one in which they own containers and move chemicals as an alternative to the tanker business, and again has a 10-year record of growth. Has a business that generates, this year will probably do low 20% return on gross unlevered assets. Right? I don't know what the working capital current liabilities are of the business. I don't know what the net capital employed in the business. But even on the gross number, it's 22%, down from 30%, because they've significantly expanded the fleet, and therefore that's reduced turns. But that means over the next 3 to 5 years, they'll put minimum amount of money back into the business, significantly improve the turns to get it back to where it was earlier, and therefore generate really good returns on that business. So we think those are those two segments alone are a significant part of what the market is missing. In the shipping part of the business, it really is an oligopoly business. You don't see that through the numbers. And the fact of the matter is, because the last number of years the business has been difficult, one competitor is in bankruptcy. One competitor for the last 2 years has been kept alive by the banks who continue to lend the money, hoping at some point that the assets can be sold. So therefore not reinvesting in the business, therefore losing competitive advantage. Two companies, one of them, another Norwegian company, has gotten out of the business and chartered all the ships out to Stolt. So the competitive landscape has significantly changed to the point where we almost think there's a duopoly left in this business. So, that we think is an important thing. What we also point out is, when we talk to people about StoltNielsen, they'll also say, oh, that's a value trap. That's obvious enough. If you look at the history and you look at all these things you're telling me, the family controls it too. They're never going to do anything different. You're never going to make money in it. And what we've kind of come to think is that the concept of what is a value trap kind of really does change. For example, we think the best analogy to that is for 30 years, anybody who wanted to buy a railroad in the United States, was fooling themselves, and that was a value trap. That's not a business in which you can make money. Yes, they do have monopolies where they move freight through certain places, and yes, they have competitive advantages, but that's never going to manifest itself in terms of higher earnings. There's a guy who, was a value investor out in Omaha who made a big bet a couple of years ago that history was not indicative of what the future holds. And that's what we think here is, this business here is one in which there are significant changes that the market is not paying attention to that we think manifest themselves over the next couple of years. And that segment, which hasn't generated earnings or interest, has a very significant improvement given how the competitive landscape changes. And economics 101, supply and demand, it really does work over time unless there's some extenuating circumstance, and there's not here. The other thing about the business too is they move chemicals, and chemical manufacturing has a number of different things that are changing. And since we spent 15 years thinking about this company, we've spent plenty of time talking to people in the industry to understand those dynamics better. More and more chemicals are made in smaller and smaller quantities. More specialization on the part of a chemical company enables them to charge higher prices for a differentiated product, and that means that quantity sizes that when you then move chemicals are smaller. Stolt ships have 49 to 50 different compartments that then tend to be smaller, or they're also stainless steel, so they're focused on this specialty business with smaller parcels to be carried, and they're the only ones still who have invested in that business. We think they have well over 50% market share in this business. And since chemical companies are producing more of those chemicals, because that's how they make more money, and then in addition, what you also have is the chemical business. There are two dynamics that are clearly identifiable. One is the significant growth in chemical production in the Middle East, given the source of low hydrocarbons, which is the initial building block of that business. Those chemicals are not going to be consumed in the Middle East. They're going to have to be transported someplace else. That's going to lead to increased demand for a tanker in the chemical business. At the same time, the United States, given low natural gas prices, is going to spend a lot of money. Right, you're going to have Dow Chemical investing $15 billion to build a plant in the United States. You're talking about Shell building a multi-billion-dollar plant in Pennsylvania. All of those things mean more and more chemical production in the United States. They're going to need to be transported someplace, probably to Asia, because that's where it's going to be consumed. So therefore, ton-mile movements, we think, are favorably improved for Stolt and given its position. And this is a restatement, of course, those attributes that I've just enunciated. Here's some of the parts the companies provided themselves in terms of what they think the individual business segments are worth and how they came to those conclusions. We think those are all extremely appropriate and logical valuations. And as I say, as importantly, the tanker business, I think, has a significant increase in what the valuation is on it, because it'll start to demonstrate and generate earnings that it really hasn't in the past, and good returns on equity and assets because of the competitive landscape. In addition, when you do have Dow Chemical building $15 billion plants, that's all predicated on producing a chemical someplace and needing it to get someplace else. So the logistics part, the transportation part, is an extremely important component, because they're not going to build another plant in a different location closer to market, because that's a 3 to 4 or 5 year project, and you're talking billions and billions of dollars. So to change their manufacturing is kind of just not logical for them. Clearly, the better thing to do is to pay a little bit more money to transport the chemicals from where they produce them economically, given they have a very low cost of natural gas liquids here in North America, to where they're being consumed. That's obviously the more logical solution. Another company we think that highlights this issue on securities, there's a number, Samson manufactures furniture in the United States, in China, which is sold in the United States. So there are a number of U.S. competitors. Ethan Allen and Furniture Brands are two of them that we think about regularly. The valuation between Furniture Brands and Ethan Allen is vastly different than what it is in Samson Holdings. And Samson has a balance sheet that, of course, is significantly better than Ethan Allen's and much better than Furniture Brands, which has viability issues given pension obligations and given the debt load that it does have. In addition, one of the things that Samson does own, and in addition to the cash they have, is they also own some publicly traded securities. They own 15% of Furniture Brands, and yet Furniture Brands has a higher valuation on the entire company than Samson does. Vastly different kind of balance sheet. So once again, Samson also has the other problem of limited liquidity, right? There's one guy who owns 70% of the company, so the float isn't that big, and therefore the company gets discounted because of that. We kind of think that having a guy who owns 70% of the company and therefore clearly interested in how to build value, and a person who's got a 20-year record in running this business where he's created a huge amount of value. So someone who knows what they're doing, has demonstrated that, and clearly is motivated because he is by far the largest shareholder. All those things act against the valuation of this business, and we think those are all great attributes that aren't anywhere reflected. Of course, the difference that will bring out valuation here is the furniture sales in the United States are still predicated on new homes and new home ownership, and therefore a ramp up in that is probably a prerequisite for increasing purchases on the part of consumers. Yeah, and if you look at the valuation of the business, as I said, we've got 70 million is EBITDA on that assumption, which is 2/3 of what it was at peak, and we think the company is much better positioned today. The implied value in the company is 2.3 times EBITDA, so an extremely modest valuation. Here's another company, New Market Corporation. On the side here, we have it never hurts to take a profit. It's an old Wall Street axiom, and our response to that is, do you really think? Do you want to bet on that? New Market we first invested in 1998. So in 1997, the company, 25% of stock is owned by the Gottwall family. The Gottwall family is in their second, third generation, so some of the second generation, some of the third generation running the business. They buy back stock. They buy back 25% of the outstanding shares of the company, significantly reducing the float. And they do that at $45 a share. So a year later, the stock's trading at $35. And so we think, gee, that's an interesting price point. We're paying something, and the family didn't tender in, instead owned more of the company, so therefore used the company's money to buy back stock and pay $45. So if we could buy stock at $35, less than the insider sets of interest. Stock proceeds to go from $35 to $3.67 over the ensuing number of years, because that's why you need a margin of safety, because everybody makes mistakes, even the insiders who know this company well. This mistake they made was to buy back the stock. They levered it up. They took on debt, and so they had $700 million of debt. At that same time, the business went through a number of difficult problems. Two of the largest users of they make additives for engine motor oil and for lubricants. And their largest competitor is Lubrizol. So large customers were Quaker State and Pennzoil. The two of them merged, and they went to all the suppliers and said, who's going to give me the lowest price? And given that one of the competitors, a division of Chevron Oronite, had built a new plant, so the industry had increased capacity in a business that has very little growth, that you had a decline in demand, and you had a competitive situation, so pricing got very difficult. In the meantime, they had levered up, and so therefore they were in a difficult situation. So we continue to buy stock all the way down, because that's all we know how to do, is when we make a mistake and the stock goes down, buy more of it. Continuing to buy stock down to $3.67, and that probably was in like 2003. By 2005, the business definitely isn't going out of business. Stock's rebounded, it's at 15, but what we looked at the time was we thought the next year they'd generate $4 a share in free cash. And we thought that was a sustainable level. And so stock's trading at 15. In the meantime, the debt's gone from $650 million to $150 million. So the debt's been paid down. The earnings now are demonstrable, we think. The valuation modest. And what gives us that conviction on the earnings, again, is having been in it since '98 and watched the industry and what it did, the key was that Lubrizol, it always was an oligopoly business. There were 4 competitors, because that's what Newmarket had done by buying out Texaco's and Amoco's business, was help consolidate the business, and they thought that provided a really good opportunity. And that really did prove to be the case, because in '04, Lubrizol bought, I forget the name of the company, but it was a chemical additive for hair care products. And instead of saying that they were a growth company in a non-growth business, they said, well, gee, in this lubricant additive business, we're going to convert it to a cash generative business. So they shut down a plant, and they changed their whole pricing policy and how they were thinking about the business. So you had the largest player, the price leader in the business, suddenly saying, we've got an oligopoly business, let's take advantage of that fact. And so from '04 through '05, 5 price increases the industry put through. And each time they put through a price increase, the cost of raw materials, oil, and oil derivatives went up. And so as soon as they would raise the price, the cost would go up and no margin improvement would occur. Now this happened 5 times. What we thought that clearly demonstrated was a number of factors had gone on so that supply and demand really had transferred itself, and the producers here, the 4 of them in this oligopoly, were in a position of pricing power and had that capability. And at some point, the cost would stop going up. So in June '05, we doubled our position and became a 13D filer in the company at 15. What happens in the next year is that the earnings now do occur and does play out kind of as we had thought. Now here is where we actually make our huge mistake ourselves. So within 9 months' time, the stock's gone from 15 to 39. And I've done my model and said, oh, it's going to generate $4 for the next number of years. And in talking to the CFO, had pretty high conviction that the numbers weren't going to grow a lot. And that's partially because I listened to the CFO, because he was going through the '98 to 2003-04 period of time, the difficulty that he had and the industry had. He became very focused on how difficult things were. And the idea that things would change was hard for even he to perceive. So therefore, being a little too close to the CFO ended up being somewhat a negative, because his thought process came over to mine. And then I had done my valuation, and I say, gee, at 39, it's generating $4, almost 10 times free cash flow for a business that doesn't have much growth. Maybe this isn't such, it's the kind of a full value. So I sell half of my stock at 39. So today, in December this year, I sold the balance of the shares that we owned. I had sold it over time after we got a $25 dividend, and I sold it for $275 a share. So $300 all in, and I sold it at 39 in 2006. So the idea that you can't hurt taking a profit, we think, is extremely wrong, especially when you do what we do, is look for businesses that we think have interesting dynamics, an oligopoly, controlled by a family who's looking to generate returns, who have helped consolidate that business. Those dynamics is a high leverage business, so therefore the earnings can dramatically grow, and to let that run as an opportunity, clearly was a mistake, because they also earn about $16 a share today, not $4. And then we also made the mistake of having done those models and coming up to $4. That kind of grounded us to say, well, $4 is kind of the number, and 39 is not a bad price. So actually, the identifiable situation I can think I lost the most money ever in my life was selling the stock at 39. Right, you can only lose 100% of your investment if you make a bad investment and it goes to zero. Here you could lose 200, 300, 400, 500 times your money. And then since I'm talking about, we've got Superior National, as David says, not always the bed of roses. It was a California workers' comp company. And this was a huge investment for us. So in 1998, we had a significant investment in the company and thought it had a lot of interesting attributes. Significant insider ownership, and that was a company called CapZ. It was a private equity firm funded by Zurich Re, run by Zuckerman, who used to be the gentleman who ran National Indemnity before Ajit Jain. So smart guy, smart money. They were shareholders in this company for 6-7 years. At the bottom of, at a difficult time in the workers' comp market in California, cyclical business, purchased the second largest workers' comp writer in California. To do that, they did a rights offering. One of the things we regularly look for are rights offerings, especially when there's an insider who is a participant and the standby purchaser on any shares not taken up in the offering. Clearly, he's looking at the opportunity set and thinking the price-value equation is extremely positive. So we subscribe to the rights and make it a 20% position in our portfolio, biggest position I ever made it. Because what they had done was, in making the acquisition, they had also entered into a number of reinsurance contracts. One on a retrospective basis, where they had reinsured, in spite of the fact that the company had done 2 huge reserve additions, one of $250 million and one of $450 million. They bought a policy that covered them for $200 million of any adverse development on a go-forward basis from American Re, one of the 2 large direct writers of reinsurance, well capitalized, clearly has the capability to pay. And then in addition, they went to American General and reinsured 100% of the business on a go-forward basis for the next 3 years with a 35% ceding concession. So what that meant was they were guaranteed to make money for the next 3 years because there was no risk assumption on their part. All of the risk was being passed off to American General. The pricing was still difficult, but the 3-year window gave them the opportunity for the next 2 years to continue to write the business. And if prices still hadn't improved by the 3rd year, then they could start to cancel policies and make adjustments, but would have locked in the earnings. So given all of that, we thought, gee, it's all lined up to be a pretty positive situation. So from the middle of 98 through the end of 99, the stock proceeded to go to 0, and I lost my entire investment in this business. So what are the lessons that I learned from that? The first lesson I learned is even when you have high conviction level that the investment looks good, you have to also size it properly in a portfolio. And the idea that it was a business that had leverage on it, that has uncertainty, and there's a lot of leverage not only in the debt that it took on to make the acquisition, but also, more importantly, the insurance reserves or a multiple of that and a multiple of equity. So any miscalculation in that could be deadly to the company, which it ended up being. But the mistake I don't think I made is I'd be stupid enough if I were confronted with the situation again to probably invest in it again, because I do think the dynamics all lined up well. There's 1 or 2 particulars of this situation that I wouldn't, and that had to do with my understanding of how reinsurance works today, which I did not appreciate fully at the time, and that is it's always a bad idea if you make a bet with a guy and first you pay him, and then when he finds out that you took advantage of him and he lost money, he has to pay you, especially if that contract has a mandatory arbitration clause, and especially when he has the capability to say, no, I'm not going to pay and I'm going to go to arbitration, and you don't have the capability to withstand 2 years of waiting for that process. So therefore, the nature of reinsurance contracts was not, and then of course, there's not this concept of, which I would have thought prior to that, it would be, this is a reinsurer is a sophisticated, knowledgeable investor who understands the risks of what he does, and therefore, I don't have some obligation, and it's not, let the buyer beware kind of, times 2, I would have figured. It's not the case in reinsurance contracts. There's an obligation of full faith and duty and full disclosure, and if there's anything you possibly might have known and didn't tell the reinsurer, there's actually clauses that say, well then, you should have done that, you did something wrong. So those particulars are things that I was not aware of at the time, and I'm painfully aware of today. But the idea that I would have invested in a company that would have made an acquisition that would have leveraged up in the process, all of those things still, I think probably would be extremely interesting. The problem is if there is a viability issue, to make it a large position in the portfolio is clearly problematic. Fortunately, it wasn't so problematic because we're still in business today. And our annualized rate of return, in spite of a 0 on a 20% position, is still significantly above market. Here's a number of disclosures on various of the companies. And then these are various companies that were mentioned in the interviews, and I think we somehow were supposed to put up what it was at the time. And now I'll open it to questions. Did I take too much time? Did I talk too much? Anyway, sorry. And then this handout here are like various companies, some of which I didn't mention, that we've invested, know well, have opinions on. We think are interesting kind of case studies for value investments today, into the future, some of them.
All right, so George keeps beating on the fact that the macroeconomics aren't really what's really important, but I'm just curious from your perspective, is there ever anything, like where do you draw the line on when something happens on a macroeconomic level that you have to act on it and it changes your portfolio in some sense? Like, is there ever that time where you just have to change it?
Well, I don't know what's macroeconomic and what's not. And by that I mean, so we invest in the energy business, right? And so the energy business, clearly the price of the commodity is extremely influenced by macroeconomic events. And even the United States, North America, natural gas prices, and I have views on what the future of that is, which could change because there could be events that kind of unfold. So therefore, with regard to the companies we invest in, what the outlook for the future is influenced by external events, and we do think about that somewhat. So I guess there can be macroeconomic events that would give us a different view and would temper how that impacts a company we've invested in. Now, our predictive capability to know that is clearly nothing. Non-existent. So we don't spend a lot of time thinking about. And then, of course, having started to invest in Asia back in '06 and being in Asia, 4-5 weeks of the year and visiting with 25 managements in a week and getting what's going on in certain manufacturing segments in China, is interesting to get a perspective on how the world does work and macroeconomic events that are unfolding or might unfold and what significance that might be. So I think we think a little bit about it, but not a lot about it. Okay.
So since you have this big interest in fracking, I was wondering what your thoughts were on fracking in Pennsylvania, New York, and Delaware, and the changing regulatory environment and the impact on the companies.
Almost everything in life has risks associated with it, right? And my wife, who, because her plane didn't make it, would be here listening to me drone on, as she hears all the time over the dinner table, also sits on Community Board 7 in New York City, so it's the Upper West Side. So therefore, a community that by its nature, when they hear the word fracking, spit on the ground, the issue comes up, and occasionally she'll even talk to people and say, well, there's a positive side to fracking. So any process like that entails something that can go wrong, and I'm sure there have been situations that have and can in the future too. As she points out, being different in terms of her perspective than mine, but the alternative is the world needs more energy. What's the source of that energy? What are the risks associated with each of those sources of energy? And one of the options that she thinks about is nuclear, and the idea of using nuclear energy to as an alternative. And where do you get the energy source that you're looking for? Is it coal? Is it nuclear? So all of those things have risks and problems associated with it. For the industry to continue to for there to be some process where they continue to get better at it, to look at liability, and they're going to get, if something goes wrong, they're going to get sued. They're going to be, a process to correct that. And to get better in that is, I think, positive for the better companies. And I would somehow think that the larger companies continue to kind of advance that, because that's a barrier to entry. Smaller oil and gas companies, competitors in the fracking business, if there is something that they're doing wrong or don't have processes in place to reduce the risks and mitigate the risks and identify the risks when they do happen. So I think that's all positive, and you can't have one without the other. You can't have a world where you just produce and cause problems and disregard that. So that's not an alternative. But I think what the potential negatives are in the process of producing energy, which people do need in some form, there's trade-offs in life, and that's one of the trade-offs.
Thank you.
Sure.
When you were talking about a lot of the oil and gas companies, in terms of commodity risk, it was good that the service companies were kind of separated from that. But with Panhandle, I know you didn't go over that, but could you just touch on how you thought of commodity risk when it came to Panhandle?
Panhandle is different than most companies, and oil and gas companies, have a process, and where Panhandle is different than almost every other oil and gas company is everything it does and all the resources it really has is on mineral lands. So unlike other companies in a finite business with a finite resource, Panhandle has, to a certain extent, an unlimited resource. And those minerals are in perpetuity. And what happens is, instead of having to go out and identify new places to explore for oil and gas and spend all the money and take all the risks associated with that, Panhandle doesn't. Panhandle already owns minerals in producing areas. Other people take those risks, spend that money, spend that time and effort, and then come to them and say, gee, we're interested in drilling a well on land that you own mineral interests in. Do you want to participate in that or not? And then Panhandle has the right to participate or not. So it's in a way, it's kind of like they're being the broker to Warren Buffett, and Buffett calls up and says, I want to buy stock XYZ, and if you want, you can buy along with me. So not a bad position to be in, because you know who the guy is calling up. So if it's Devon Energy and they've been drilling in the area and they really know it well, you could say, well, I'll put my money down and take my risk too. So you have that kind of opportunity set, which you don't normally get in the oil and gas exploration business. In addition, what they also get is preferential economics, because it would be kind of like that broker in that situation. Not that commissions cost anything today, but if they did, I don't have to pay the commission. So Panhandle doesn't have to give away the mineral interest, which is 25% of the oil and gas that's found. So therefore, that means, if there's 20% royalty, that means they find 25% more natural gas or oil in that same wellbore than everybody else does for their pro rata money. So their rate of return is higher. So they get higher rates of return. They don't have to spend the exploration dollars. They get a free call and a look at the opportunities they want to participate in. So it's a very different company. But still, at the end of the day, what's going to drive Panhandle's value is if the natural gas price goes up or not, because that's the resource that they have. Now, they're levered to that, and they're advantaged given all of those things. And a lower price is better economics to them. And they do have interest in a number of different fields. So therefore, the Fayetteville is one of the lower cost fields that still has high activity levels today. So any increase in price there fully is going to accrue to their benefit of the minerals they own. In addition, in western Oklahoma, there are a number of areas that do have oil prospects on them. They have 40,000 acres of minerals they own in western Oklahoma. 25,000 is in an area similar to a year and a half ago. Apache bought a company for $2.5 billion that had 10 times as much minerals that were leased minerals than Panhandle owns outright in perpetuity. So, under that, one could argue there's a $250 million value associated with those minerals. It's a $240 million market cap company today.
Okay, thank you.
And Panhandle, I own a lot of stock. I own 9% of the company. I'm a director of the company since 2004. So, as with all these things I talk about, I own all of them. I'm biased. Don't believe a word I say. I'm talking up my book.
I'm wondering if you could talk a bit about one of your edges. You talked about information edge being one of the ones. Obviously, behavioral comes first, and then there's analytical and information. When it comes to information, an edge or a strength, obviously there's an industry perspective to that as well. And I'm wondering if you can speak a little bit to how much investment you guys make as a company or you've done over the years in specific industries before you make an investment, and how you would go about doing so? Is it trade shows? Is it industry publications? Is it just meetings with management? And at what point are you comfortable enough to make that first investment?
I'm not smart enough, disciplined enough to do all that legwork before I make the investment. Like, I'll do some work probably, but I'll probably make an investment that intuitively makes some sense to me, and then spend more time after I own it, kind of fully understanding it. And then I probably bought it too soon, so therefore I've got 3, 4, 5 years to study the business and the industry. And then since it was probably too soon again, the value equation's probably still pretty interesting and maybe potentially much better. So that's the way it's kind of worked for us.
And in that 3 to 5 year span, who do you trust the most? Is it management? Is it industry publications? Like, what do you rely on most, or where does the hunch come from?
You know, in Builders Firstsource in BMC, it was beginning in '09. It wasn't through publications. It was really conversations, including operating management. And then the business itself is really it's a very localized business. But I think that's one of the things they say about real estate is it's really a very local business. And so when people talk about home building in America, you know, well, what are you talking about home building America in Phoenix? Are you talking about in South Florida? Are you talking about it in Boise? Are you talking, you know, in Kansas City? Because those are 4 markets that probably are very different than each other. And with that distribution business, the products and services they provide in each market, there's a range of potentially 10 different things. And in certain markets, they do 5 of those things. In other markets, they do 8 of those things. And in certain markets, they do 2 of those things. And who the competitors are in each of those markets is very different. Are the national home builders in a market? And that drives kind of a very different customer base. Is it a place like Eastern Idaho that has no national home builders and is a, you know, much more smaller builder community, and how that different? So you continue to kind of build these things. And then even other industries, of course, help you out, because in that industry, you know, we in '05, '04 had the great idea that manufactured housing was a really interesting industry to invest in. Right? It had gone from 397,000 homes in '97 to 145,000 homes. So we said, hey, 145,000, 10% of the homes built in America was 25%, 397. If you go build, if anybody's ever visited a manufactured home production facility, you build the home in 3 days. You build it in a factory-controlled environment with no rain. You have a supervisor watching the worker, so he didn't go out and go to lunch and have 4 beers and then come back, and he didn't put the insulation behind the wall, which you're not going to know, or didn't run the electrical properly. You see all that. So the cost and the value equation of a manufactured home is one in which we thought, gee, that's a pretty good proposition for the home buyer, the dollar they spend for the value they get. You know, this is you know, a better alternative. So, you know, we follow that industry since '05, and it's interesting to have seen that because it does relate to home building and has certain relevance. Of course, the huge mistake we made there was, you know, who was going to buy a manufactured home in 2006 for $80,000 when you could buy a $200,000 site-built home, no money down, reverse mortgage, so the monthly payments were less for a site-built home at a much higher price than what, instead of manufactured home, since they did the same thing in '97 that the single-family business did in '05, '06, or '07, that is give money to people who they had no expectation were ever going to pay them back. That industry, therefore, had corrected and therefore charged, you had to put 20% down, you had a 13-year mortgage, they charged you 8 to 10% interest. So, and they looked you in the eye and determined you're going to pay back the loan. So, you know, it was a very different value proposition, and therefore weeded out a lot of potential buyers instead to go buy the more expensive site-built home where you were just given money. So.
Thanks.
Hi, so one of the key lessons you said was sizing your portfolio, so don't take like a huge 23% position. How do you think about allocation in your portfolio currently? Like, do you take any short positions or hedge positions? And also, it seems like the companies we talked about, like you have a lot of exposure to natural gas fracking, oil and gas, home builders, and home recovery. So just wondering like how you think about allocation in your portfolio, and when you're doing your sizing, how you think about that.
The largest position we own in our portfolios today, in the separate accounts, is probably around 17% of the portfolio is one investment. and in partnership I run, over 20%. So what I didn't say that I wouldn't have a 20% position. What I said was if I had a 20% position, I sure wanted to make sure that the viability of the business was not in question. So this is a company with net cash on the balance sheet, generating positive earnings, significant insider ownership also, attributes that I think mean there's price risk to the stock, because I know that, because my two entry points were at points where the stock got extremely depressed. My entry point, mainly a rights offering it did in 03, 04 at $2.20. And then in 08, stock came down below $4 and bought more stock there. So I know it's volatile, the price, but the balance sheet and the nature of the business is such where I don't think I have a viability issue, so I will continue to make it. Now I have a long history with the company and a strong conviction that once again, there's a misperception on this business. It's two competitors. There are three competitors in the business, so it is an oligopoly. And what they do is they install equipment in deep water for oil and gas companies, oil companies if it's in deep water. And there are only three people who can do that. So you're talking about installing wellheads, pipelines, umbilical controls, manifolds, compression equipment in 3,000, 4,000, 5,000 feet of water. So the technological capability is high. There's a huge engineering content to this. So they have 2,000 land-based engineers. The project time from when they first learn about it to execution is probably 6 years. So because of that, I think there's a huge barrier to entry in the business. Yet I think the profile on offshore well completions, because you have more and more offshore rigs that drill more and more wells, more of which are successful. So there's identifiable discoveries. So the backlog of activity is, we think, dramatic. So we think there's the capability over the next 5 years for revenues to grow at a compounded 20% rate. The business also is different than offshore drilling, which is kind of in the same market because it's oil and gas related and it's deep water, because there's no leverage associated with a drilling rig. There's maybe pricing that you can get on it, but you can't have efficiencies. Here, what you've got is when you actually go into the installation phase for 3, 4, 5, 6 months on the heavy part of it, you've got multiple pieces of equipment that you bring to the location. The more business you have in a geography, the more optimization you can have in the fleet. Therefore, we think the higher margins you're going to generate over time. So we think there's margin expansion, which you've seen in the industry. At different points, it's had break levels to it. We think the competitive landscape has also changed over the last year even. There was one person who was a peripheral player who had some equipment. They joint ventured with one of the other three main players for the next 5 years. So McDermott is a peripheral guy who'd like to get into the business and had contracted out some of the equipment of Allseas. To have Allseas then joint venture with Technip means that took away a potential merger opportunity. So you've got barriers to entry, you've got significant growth in revenues, you've got the capability to improve margins in the business. And my first stock that I ever bought was Atwood Oceanics back in 1976. So the oil and gas offshore business is one in which I think I have some industry understanding and knowledge of it. So,
Thank you.
My question is more towards, are those days over now where you just look at the fundamental principles of value investing, where you just present value to perpetuity, all future cash flows, constant growth, and value of the assets, divide that by the number of shares and see if the market is mispriced by the number you get? Or are you finding that you're going to have to add a lot more variables now, be a little bit more sophisticated with growth to remain competitive in your investing strategies?
No, what I would say, is that, and maybe you make mistakes as you grow older over time, but there's clearly investing in a company that has growth potentially is extremely rewarding, right? It's better than investing in a cheap stock, right? If the value is constant and you buy it at a discount, and even if that value margin dissipates and it takes some time to get there, it's kind of a limited return that you get from that investment. If instead you've invested in a business that's really does have good growth and the value continues to increase, that's a much higher rate of return. So therefore, to look for businesses that you think, and now there are two different growth I talk about, right? Because I talk about Builders Firstsource, which is really a reversion to the mean kind of growth. So it's not that I'm saying home building is going, as opposed to Subsea 7, what I'm saying is the gross amount of business and the size of the addressable market is growing dramatically over the next number of years. It's going to double in the next 5 years, 3 years, 4 years. And then therefore, they're the beneficiaries of that. So that's a riskier growth to kind of project because I don't have something to look back at history as opposed to Builders Firstsource. I've got history. I've got, if you look at 30 years of home building in America, to project that there's going to be 1 million homes built in America at some point, and that becomes at least an average that things move around, well, that's a much lower level of risk. Alan Weber is a guy in my office. Alan used to work for Fund America, which was Jack Byrne, way back when, and a bunch of other value people. Was chatting with me just the other day, and he says, "Bob, you sound like a growth investor. What happened to you?" And so I do think that a lot of the companies that we've invested in today, there is some growth. Some of it's reversion to the mean. Calfrac, I'm really talking about. They've got more equipment, bigger capacity, therefore should generate more revenues. Getting back to the same kind of economics they had at a previous time in the cycle. That's all. I think that's not so difficult to prediction. The time of it is difficult to predict. But again, if it's 5 years instead of 3 years, it's still going to generate a really good annualized rate of return.
And just to follow up,
Yeah.
so this probably comes a lot with experience, but what variables do you think that you have to add into your investing strategies and in your analysis to transition from a value investor towards a more traditional style investor? Like if you were adding in a little bit more variables, when would you consider yourselves a traditional investor over a value investor?
Well, first off, I would say, what's a value investor versus a traditional investor? I think we're all investors. And the approach we have is, I would say value is not that I'm trying to buy a cigar butt, but what I'm trying to buy is something for significantly less than what the intrinsic value.
Exactly.
And what's intrinsic value? Intrinsic value is the future cash flows. And there's different ways to make estimates about the future cash flows, whether that's based on reversion to the mean, whether that's projecting in the tanker case, it hasn't demonstrated that return over time, but intuitively, given how much investment they have in the asset and the key role it plays and the limited number of competitors, and therefore the pricing power it should have, that should generate really high returns. So, that's, again, they haven't done that. That one I think is less projecting because I'm not changing the size of the market. In Subsea 7s, I'm projecting the market size. But even that's driven by the fact that I know that there are more oil and gas wells that have been drilled in deep water that have been discoveries. And it's not a huge leap of faith to think if an oil and gas company spends a decade identifying a location, drilling a well, and they find oil, that's going to cost them from that point forward less than $10 a barrel to start producing, that there's a really good economic chance that it's going to make economic sense for them to spend that remaining $10 per barrel to be able to produce it and sell it for $90 a barrel. So therefore, the idea that the activity levels will be significantly higher, I don't think takes that much guesswork on my part. So those are the dynamics that I'm looking at and projecting.
Great, thank you.
Okay, well, running out of time, so one last question. Odini, last question.
Take this too short for this. The one stock on the list that sort of stuck out at me was Leucadia. I'm just curious, it seems like they're into all sorts of different types of businesses and such, and I'm just curious what you felt what competitive advantages the company had, because it seems like management's sort of all over the place. So I'm just curious how you identified that stock as a good one to have.
What I mentioned to David was one of the things where we've had really good success is we bought a cigar butt, and in the process we ended up with either a good business or more likely a really good management that really knows how to allocate capital. And Leucadia is that kind of example. So we invested in Leucadia first in 1987. And Leucadia is run by two smart investors that will invest across a broad range of things. And Leucadia, and that's what it is. Cumming and Steinberg have run the company for 30 years and have a great record of compounding value. And so it's kind of like investing with any portfolio manager who's got a 30-year record of compounding it. Have they compounded book at like 18%? And so therefore, you can look at his portfolio and say he's got all kinds of companies and all kinds of businesses. I don't get the rhyme or reason. There's no business here. And one, maybe to a certain extent, you could actually say that about Berkshire Hathaway. It's kind of like, there are some businesses there, but there's a lot of it is the reinvestment of capital is the kind of the thing that you are assuming based on historical records. So Leucadia guys are really smart people. They've kind of done a generational issue because they recently announced combining with Jefferies, which is a company they control, and the two guys who run and built Jefferies, who know a lot about capital allocation, who share a common view, because there's definitely a view in Leucadia, and that is that inflation is something that probably makes sense, and there's a number of commodities that are probably extremely well positioned. They have a very large bet in copper. They had a very large bet in iron ore, which they've sold off their interest in. They have a bet in timber in the United States. They bought in not so long ago into National Beef, a protein producer and a consolidating business they think has positive earnings in the future. So it's really the reinvestment capability of people. The other thing about Leucadia is that it'll always sell at a modest price because people look at it and say, well, I can't project the next 5 years because I don't know what he's going to invest in tomorrow. And the uncertainty associated with that means that people aren't going to pay a price that is reflected. You can buy it for less than book. And it's got a huge NOL to it too. So all of those things are, I can't see the future, and even though he's got a great record, how do I know he does that tomorrow? And so that probably makes the opportunity today, which of course they've also recognized that opportunity, I do think, because in acquiring Jefferies, it's a pretty fair heads-up deal, it would look like, but I would argue that they've done a really smart thing. They've done two things. One is they have this large NOL, and by owning all of Jefferies, they're going to shelter the Jefferies earnings and accelerate the use of the NOL and therefore make that NOL worth more money today. But more importantly, in the next 5 years, my wild-ass guess is that Jefferies continues to build its position as an investment banking firm and continues to move up the ranks in that business, a business that today everybody thinks is a horrible business because it's really had difficult times and it's generating modest returns and has all kinds of risks associated with it. True. The fact of the matter is it's also a cyclical business, and it's certain their position competitively continues to improve. They continue to buy different businesses and aggregate them in. A lot of those are commodity-based. Once again, they share the view of Leucadia that commodities have a very interesting future to them, and therefore to be the preeminent investment banker to Aubrey McClendon and Chesapeake probably is a good business because there's a lot of investment banking business to be done. And my guess would be in 5 years' time, UBS, after firing 10,000 of the 60,000 employees and maybe firing some more and having fired some more, the business will turn into a good cycle and will generate 20% return on equity. Between here and 5 years from now, book value compounds at 15% in a reasonable environment, and therefore book's not 16, but it's 32. And suddenly people will be generating 20% returns on equity, and UBS will decide they want to have a bigger presence in the United States, and they're going to buy Jefferies because it'll be a bigger firm that will make them a larger investment banking firm. And so they'll sell out for 2 times book, or some, because that's what investment banks sell for in good times when earnings are strong. So they'll get a significant improvement and realization, as opposed to Leucadia will never sell for 2 times book, because there's always the uncertainty of what are they going to do tomorrow. So now they captured that full opportunity for all of the Leucadia shareholders themselves. And so, in that process, I think fair deal going in, but a very different valuation on the outside, and therefore capturing more of the opportunity for themselves, which are, in full disclosure, after I invested in 87 and 88 in all these Leucadia entities, I sued them 3 times. And when I settled in 1992, I had a standstill agreement with Leucadia National, so I couldn't go to the annual meeting, I couldn't talk to the press, I couldn't own more than 5% of any of their companies, and it was a 10-year standstill agreement that I had with them. But I have the utmost respect for their investment capabilities, even if sometimes when they deal a deck of cards, how they deal out that deck, you want to be on the Leucadia side of the table because it potentially is more advantageous. But they're not the only people who do that.
Well, at this point, I normally ask this question to all my guests. What is the most important thing in life and investing that you learned over the last 30 years?
It's to have fun. I've been really fortunate. It's really a great, fun business. and I enjoyed it, even though suing Leucadia and I've been involved with I've been the named plaintiff probably in 30 class action lawsuits over the years that I've been investing. And it happens, you could imagine with some frequency it has that risk, right? You buy a company because it trades at a significant discount to what it's worth. Why does it trade at a significant discount? Sometimes it's because it's controlled by people who don't have necessarily a sterling reputation, do different things that therefore redistribute the wealth to themselves. And so in that process, instead of selling and moving on, I'm a little bit Don Quixote and I tilt against windmills. And so I get involved with companies and say that's not right and it's not the right thing to do. And so it's probably taken a lot of time and attention, and I don't think the return on it has really made sense. And I try to do less of it and look the other way now. But it's still exciting and interesting things. And then for the people who work for me, I think I give them kind of broad discretion to kind of what they want to do. And it's the same belief. It's kind of, if I ask you to do X, Y, Z or working something, people don't mind, obviously, if I ask them, they jump in and help immediately. But I always think if they go out and kind of learn for themselves and make some mistakes, but also start to find securities and they're the ones picking them, the culture of the firm is one in which picking stocks that work out is kind of what you want to do. And that's what kind of you can feel really great about. And so therefore, to give them that opportunity to feel really great about what they're doing and to go in a direction that they want to go, that's a great thing. And it's good for me and it's good for them. And I have fun at it, and hopefully they do too.